In crypto, most people only show the positive outcome if it happens. They almost never show the mistake, the damage, and the process of build. This episode is different. This is the story of how a bad start with TORUS turned into a structured liquidity strategy. From removal and out of range LP position to another more balanced position. The process can be hurtful, but it has to be done. If you don't do it, then you would be only sitting in a position that is very deep in loss. This episode is how we're breaking down the rebuild of TORUS and why a new LP changes the whole game, or at least it does some damage control. Let's get into the TORUS TitanX LP structure. My story with TORUS didn't begin with a perfect plan. It began the way many crypto stories begin, out of curiosity and a feeling that the TORUS ecosystem was doing amazing launch. The TORUS principles are actually still very brilliant. The protocol still works solid, but at the time my player versus player narrative was a non-existent. TORUS looked interesting because it sat inside the TitanX environment, where staking, scarcity, and buy and burn mechanics suggested there might be a deeper compounding opportunity. And TORUS still has all those elements, both actually creations and stakes. But early interest without structure is still just exposure. My first move into TORUS with was planned, but the process behind it was not enough thought. I simply put only one creation, as there should always be a ladder. So I went too far in the timeline and too close to the longest 88-day period, and the price was already busted at the time. That matters because in volatile systems, entry alone is never the good strategy. I took it as a learning experience, but I should have planned better. The first major attempt was TORUS creation that I thought was well ahead of time on 3 days prior day 88, where you knew would be huge unlocking take place. On paper, creation looked like participation in the protocol's upside. But in practice it happened at the wrong stage of market behavior. So I took a big hit already. The result was immediate price pressure by the time the creation was claimable, and that position moved into a deep loss. This is where the market taught the first expensive lesson. Protocol mechanics can look attractive, but timing still matters. Now, at day 259, we have the TORUS launch and correlation phase past us. That is why I like to take a look at TORUS again. A staking system can be elegant and still punish entry if the market sentiment is against you. With so many times, the beginning of a mint looks good, but the markets almost always push down the price eventually. With TORUS, there is a good protocol behind. It has unique features, just to name a buy and build structure as an example. After the first TORUS creation and also the staking were both disappointing, LP position looked like the safer path. The staking interface did show a large projected ROI over 88 days, but the price was dumping hard no matter what, meaning the ROI ended up being negative also in the stake. So I simply created an LP and decided to leave it be. But in all these DeFi protocols, the creation, the staking, and the LP building the projected yield is not the same as actual portfolio progress, especially when token price and sometimes the fee structure or costs and can work against you. This was the second lesson. Yield without flexibility can turn into passive underperformance. Staking nor creation did not offer enough control as the funds were locked for too long. Rookie mistake. I take that. At that point, the story was already written in numbers. Creation had gone badly. Staking had not delivered the recovery needed. And the previous liquidity position, or LP, had drifted out of range, leaving the portfolio holding only TORUS without an active engine earning fees. So I decided to buy in DCA with fresh TORUS and close the LP. That is the difference between participating and positioning. Participation reacts to the market sentiment and creates a plan for the protocol. Repositioning uses the protocol to create a better outcome, and that requires another look at the charts. The deck screener chart tells the emotional truth better than any pitch deck. TORUS launched with excitement, expanded aggressively, and then went through a prolonged collapse by the end of year 2025. Now, at the beginning of year 2026, things have been picking up nicely. Also, the buy and burn is ticking, creating a positive momentum. That long decline after the launch hype matters because it explains why early entries suffered and why the rebuild has to be more disciplined than the beginning. But there is another side to this chart. Once a market has already been heavily compressed, strategy changes to DCA. That's the damage control you want to do it. Once you understand that the market set the price, you stop asking whether the story is clean, because in TitanX ecosystem, the liquidity is there, so hardly any rug pulls here. And then you can start asking whether the structure can exploit volatility. And the TORUS build is solid, so I chose to follow up. The re-entry was different. It was no longer about trying TORUS again just because it looked cheap. It was about combining the old positions, tokens, new accumulation, and actual chart context into a more controlled liquidity structure. That shift is the real turning point in this episode. The mindset changed from being a holder waiting for rescue to becoming an operator also in the crypto system. Now let's look at that system. The new TORUS TitanX LP is the answer to the earlier mistakes. It works across a meaningful range. Instead of locking into one passive path, the LP now has specific jobs. Below the lower edge, it still accumulates TORUS. Inside the range, it earns fees, and above the upper edge, it begins converting into TitanX. This matters because it gives the position 3 jobs instead of 1. It builds resilience into the volatility. The chosen range is not arbitrary. The lower bound sits beneath the recent local market bottom, creating room under current conditions, while the upper bound stretches into a zone where meaningful TitanX conversion can begin. Survival first, then monetization. To understand TORUS, you need the map. The protocol interface shows creation and staking. We have put all the links in the description below. The white paper documents explain the TORUS creation and staking rules. Dune gives the analytics layer for the token amount. Deck Screener shows real-time market structure. Uniswap is where the LP position is actually built. TitanX Hub shows where TORUS sits inside the broader ecosystem. This is not one website and one token, it is a stack. And once you understand the stack, the trade becomes a system. TORUS is still early enough that the market is not crowded. On the ecosystem screen, it sits around 5th position in activity, which means it is visible but not overheated. That combination is important because the asymmetry is still there. Not quite dead yet, not obvious and not crowded. That is the kind of zone where a long game matters the most. Now zoom out. TitanX is the engine underneath this story. The buy and burn mechanism, the liquidity depth matters. Because if TitanX gains strength, TORUS has a stronger asset to convert into. The ecosystem structure holds it together. That is why the goal is not just TORUS recovery in isolation. The deeper objective is building a structure that can transform exposure into TitanX. Transforming TORUS exposure into more TitanX over time, that is the long game, and the long game is about supply. Inflationary systems constantly add supply, which dilutes each unit unless demand keeps racing ahead. Deflationary systems work differently. Both of the tokens have BNB mechanics, and TitanX has today 9.5 mint USD buy and burn power, which is 16x the current market liquidity. And when supply gets reduced while participation grows, scarcity becomes more meaningful, and every remaining unit matters more. This is the ultimate big game. This is the core attraction of Bitcoin-style thinking, and it is part of why Ethereum-based deflationary structures are so interesting. Scarcity changes how time works in a portfolio, especially when you're building on the right base layer. Instead of locking into one passive path, the LP now has specific jobs. Below the lower edge, it accumulates TORUS. If capital keeps concentrating on Ethereum rails, then the ecosystems built on top of those rails inherit that energy. Price expansion follows as new buyers come in the system. So when ETH expands, the structures connected to it gain leverage. The strategy now is very different from the beginning. It is no longer about blindly creating, blindly staking, or hoping a chart reverses fast enough. It is about maintaining an active LP, reviewing weekly positions, collecting fees, and building the next ladder step. That is what compounding looks like when you stop chasing hype. You don't need a miracle, you need structure that stays alive. The beginning was bad. That part stays in the story because it explains why the rebuild matters. The redesign is active. But now the first ladder step is built. The next one can be built above it. A future range designed to rotate more TORUS into TitanX if price rises. This is how damaged positions become strategic positions, not through denial but through redesign. The machine is producing again. The beginning was messy, but now the machine is built. And from here, every move has a purpose. Subscribe our YouTube channel, Crypto Detective FI. I'll see you in the next one. But before we go, Emma has an update on what's coming. Next episode, Emma breaks down the latest news on one of the oldest token of the TitanX ecosystem. Meet Hydra. Check the links on screen and in the description to stay ahead. The system never stops.